Hey everybody, Marty Mazzora here. It is the 15th of July, 2026, with a video commentary for you. I have quite a bit dialed up, and I don't think I'm going to want to go through all of it because I think it would just simply take too long. So I am going to actually wing it a bit. I just a few minutes ago decided to do a video, just doing a ton of research, something I've said over and over again in client meetings, and I believe here on the blog as well. We remain constructive for the next few months. We remain concerned for 2027. We think that challenges are going to emerge there, and I'll no doubt touch on some of those. Doesn't mean we can't make money. Doesn't mean we can't protect our assets in 2027. And it doesn't mean that we'll feel then how we feel now about probabilities going in. So what I'll do is I think I'll just start clicking on these charts that I loaded up and just take it as far as I think it needs to. Really just want to kind of give you a feel and clients for you to hear me talk about our views, short-term and long-term, as opposed to reading them on the blog. Some of you like the videos better. So I'm going to start though with the stock market. And I've been talking a lot about dispersion of late, and a tool to help us illustrate that is the S&P 500 Dispersion Index, which essentially captures the degree to which components in the index move relative to one another. And I think that's the way to say it. Stocks could all be moving up and they could have very high dispersion, meaning they're moving up to different degrees. Breadth would be who's rising with the tide versus falling against the tide, or what percentage of stocks are up versus down is breadth. Dispersion is to what degree do the components actually differ in terms of return. So this chart right here goes back to 2019, and I shaded the areas where the dispersion index is above 30, and then threw in the S&P 500. And as you can see, in my shaded areas here, the market tends to show heightened volatility, and very often the kind of downward volatility that investors would feel, right? Here's that 35-ish% decline during COVID. And of course, it was during that dispersion index went crazy. But here the dispersion index was rising, and we had some choppiness in here in 2020. And then in 2022, we had a 20% bear market for the year. During the year, it went down nearly 30%. And you can see dispersion was all over the place, heightened during that whole time period. And then it calmed down. And then it, again, you can see that the market tends to struggle. Now, we've had notably heightened dispersion for quite some time, pretty much all of 2025 and all of 2026 with a few exceptions. And where you really get up there, and notice that right now the dispersion index is higher than it's been since COVID, and you can see the market is struggling to regain its all-time high. As I said on the written blog, this does not suggest that severe pain is imminent. It just suggests that the risk perhaps is heightened here. So again, you could say the market's having a tough time making up its mind. You could say that stock picking is essential, and we do hold probably one or two more individual names than we normally hold in our core portfolio right now for idiosyncratic reasons. And we'll see how they work out going forward. So I think I'll jump to the Bloomberg IMAP screen, and this just shows you today. And according to this is like a 15-minute delay. The S&P 500 is up 38 basis points, or say 1/3%. All the while, just less than half of the components are actually in the green. Looks like a pretty even split. Communications having a good day. Discretionary is having a good day. Financials are having a good day. Consumer staples are up a little bit. Healthcare, pretty flat. Real estate, pretty flat. Tech is down, although it's catching its breath. It was down a lot more earlier, as are industrials, materials, utilities. Energy is down 1.3%. So 5 of the 11 sectors are actually down, and the S&P is actually up by 0.38%. Our core portfolio is capturing about half of that, maybe a little less than half of that. And it's been all over the place today. The S&P 500 equal weight index, which equal weights all the components, is actually down 0.21% as I speak. So again, the index that really broadens out and just gives you equal weight is down, which says breadth right now is kind of stinky, if you will. Now, the dollar, I think if you get the dollar right, if you get currencies right, you're going to get a lot of things right. Our long-term thesis is that the dollar has headwinds that it will not surmount and it will trend lower over time. That's played out very well for us since it peaked. But you can see, it's had its rallies. We've talked a lot about that. We've anticipated the dollar moves pretty well. The technicals help, but also just having an intimate relationship with macro dynamics globally helps us, gauge where the dollar is going. Sometimes we'll react. Sometimes we'll hedge our weak dollar exposure, like hedging our gold exposure. Speaking of gold, it has really fallen out of bed. It's down on the year, down, call it 30% roughly since its peak. Remember, we were talking a lot about that. I said you don't get away from these overbought levels, particularly on the monthly chart that I was showing, without a double-digit decline. Never, ever have you. And sure enough, that was the case. So we wanted to keep our gold exposure. We are bulls long term, but we've been managing protection via a put option this whole time pretty much. Notice in here, though, looks like gold is technically looking a little more constructive. This is a bullish divergence, virtually, if that blue candle got back to this level right here on both the moving average convergence divergence and the RSI. So momentum under the surface is suggesting that probabilities favor some upside for gold going forward. Wouldn't surprise me. I'm guessing gold ends the year higher this year and probably does pretty well next year. It's a position we want to hang on to. I thought it'd be good to look at silver as well. We rode silver all through last year and had a massive gain on it. Cut half of it at the beginning of the year, and then it went up another 50%. We ended up cutting the rest of our exposure just right in here, so we got lucky. And so we were out of silver, have been out of silver this whole time until I think about a week ago. I want to say right here, we added it back. We're down a little bit in that position, not much, fairly flat. Silver is down today a full 1%, so we're probably down 2 or 3%. We took a small position, though, call it a starter position, just 1% of our core portfolio. We are seeing bullishness in here under the surface, technically speaking. Silver is a widely used industrial metal. It's in every solar panel in the world. When it got high up in here, I said, there will be substitutes because that's just too expensive. So it looks pretty reasonable to us right here. It also kind of moves with gold as that monetary metal. So if you're bullish gold, you tend to get a little more oomph out of silver, particularly if the economy is going to hold up and the industrial space manufacturing is going to hold up. Right now, it's doing pretty well. We're not worried about recession right here. So we liked this as an entry point, at least a starter entry point for silver. We'll see how it goes. If anything changes, we'll dump it like a hot potato. But right now, it's the first time I felt comfortable with it since we got out of it, right back up in here. 10-year yields, not much technically to talk about. There's no bearish or bullish divergences going on in here. It's going to react to economic data. The yield is down today. Price is up on a weaker than expected producer price index. And that's, on balance, that's generally bearish for the dollar, which is bullish for stocks. In terms of interest rates and the Fed, right now, as of the end of the year, the market is pricing in one full rate cut, and that's pretty much it. Actually, that's down from just a little bit ago, and I do notice the market's caught a little bit of steam, so somebody may have said something on the Fed because literally when I pulled up the chart earlier, it was a full rate hike plus about a 20% chance of a second rate hike. Well, that's gone away since I loaded this up just maybe 15, 20 minutes ago. So anyway, we don't think they're going to do it, quite frankly. We do not think that the Fed is going to raise interest rates at all. We think the market has it wrong. That's going to probably play well for us if we're right and the market begins discounting no rate cut for the end of the year. We can get into the weeds with new Fed chairman and the political constraints that he has and what he has been clearly doing and saying about inflation and about the Fed and about them kind of redoing their tools. One strategy would be to actually choose metrics other than the one they tend to use that are showing lower inflation and therefore justifying not raising interest rates this year. They say they will if inflation heats up. I think they will do everything in their power to keep from doing that. And then the S&P itself, you can see it's struggling to get back to the all-time high that it set back at the beginning of June. Technically, it looks okay, just looking simple 50-day moving average. It's finding nice support there, sloping in the right direction along with the 200. You could virtually call this move right in here, maybe a bullish divergence right here these last few days. Not so much for the RSI, but we're not overbought. Momentum is kind of picking up under the surface. Again, my view is that odds favor a notable breakout to the upside. I can make the case that it won't happen. Earnings expectations, and we're now just getting into earnings season, are exceptionally high, so lots of room to disappoint, but I think they are going to come in very good. We do like the banks right here. We've been adding to those here of late. And then crude oil ramping up here of late with heightened tensions in the Middle East. So this is a headwind, and it's a real political headwind for the U.S. administration. This more so. This is the gasoline index, $3.30 a gallon. We live in California, so it's a lot higher than that. But nationally, that's very high. You can see it's just off of its peak that it hit it back here in May, climbing in the wrong direction. So lots of incentive to keep ceasefires going, or I should say to keep oil flowing through the Strait of Hormuz. Our geopolitical consultants make the case that below 70 is where Iran will fire some shots to create some consternation to get that oil price back up. They suggest for political reasons to do damage in the U.S. come November. So we'll see how that plays out. So folks, just to kind of wrap it up, I had more on another screen that I'm just going to leave alone for now. Maybe I'll come back over the weekend and do another video. We'll see. But more or less in a nutshell, the immediate term inflation data this week came out comfortably and, I mean, not ramping higher. No doubt benefited from this drop right in here, right, for June. Now this right here, if this were to continue, kinetic activity in the Middle East forcing this to happen, well then we wouldn't have such great looking inflation numbers come the July print, which get closer and closer, of course, to midterm elections. So it makes technical analysis interesting, a little more challenging, and you can get caught up in those weeds when really we should be thinking about the more macro structural forces that are going to make a difference in the long run. I'm just trying to think, is there anything else that I want to throw at you now? Other than, again, just to reiterate, constructive on risk assets for the next few months on balance, but not to the point where we want to load up the truck. And we'll just kind of do our work between now and the end of the year. The concerns about next year really have to do with, again, we do not think that the Fed is going to be hiking interest rates. And we do think inflation is going to be more stubborn than they're hoping, which means the long end of the yield curve, the market will bid higher, bonds lower in price, yields higher, while trying to keep the short end pinned. So what that means is the yield curve will be steep, and that's why we like banks. One of the big reasons why we like banks a lot right here. Of course, if we do get more selling of U.S. treasuries, we've talked about Japan a little bit and the fact that there may be more of that going forward. And, just central banks in general wanting to diversify more away from their dollar assets, largely in favor of gold, by the way. We think that's a bullish box to check for gold going forward, probably for a long time. But yeah, to the extent that the world sells U.S. assets, and the massive deficit with the rest of the world, meaning the rest of the world holds far more in U.S. equities, for example, than U.S. holds in the rest of the world. So there's potential selling of U.S. assets if indeed the rest of the world wants to divest of them. And that will be really just nothing about the U.S. necessarily and how they feel about it politically. We are very internationally diversified in areas that we think are going to do well, with the inflation regime going forward, with being bullish commodities, probably for a notable period going forward. And then valuations are much more compelling in other regions of the world than they are in the U.S. But everything has its own dynamics. And let's just say we're working as hard or harder than we ever have. And we appreciate your trust clients. And we love what we do, and we love doing it for you. And I'll leave it there. Thank you, as always, for watching and listening. And I will talk to you soon. Bye-bye.